Hi there, tax accountants. I hope all is well, and I pray that as you are viewing this video, that you are in the best of health and spirit. In this video, we'll cover several questions from Chapter 12, Comparative Forms of Doing Business. So before we jump right into the questions, one piece of advice that I would give you is that for those of you that want to venture into taxation, I would strongly suggest that you enter in with a mindset that is not only focused on preparing taxes, right? Because obviously you have your peak season from the ending of January through April, and then over the summer when things start to pick up for extension season. However, there are areas within the profession whereby you can advise clients year round. And one of those is essentially what we are learning in this chapter, comparative forms of doing business. So understanding the nuances, the pros and the cons of the various business structure, so that way you can better advise clients as they are preparing to form their businesses. We live in a day and age where entrepreneurship is on a rise. So it would definitely make sense to equip yourself as a professional with the necessary knowledge to advise clients. Consultation, consulting is very, very key in this day and age. So we're going to jump right into the questions. And again, you want to focus in on ensuring that you understand the nuances of the different forms of business structures so that way you can advise your clients the right way. So we're going to jump right into this first question, and it states, indicate whether the following statements are true or false regarding the principal, legal, and tax forms for conducting a business. So as we know, the basic forms of business can be a sole proprietorship, a partnership, an LLC, and under that LLC umbrella, you can be a single member LLC where it's just one person, or a multi-member LLC where it's two or more persons. Then under the corporation umbrella, we have C corporations, which are our regular corporations, and then we have S corporations, which are a hybrid. It combines the corporate characteristics of limited liability and tax characteristics of a partnership. So A states, from a federal income tax perspective, the corporate form can be divided into two types: S corporation and C or regular corporation. So this is true. As I just pointed out, we have our regular corporations, which are referred to as C corporations, and then we have those S corporations, which is a hybrid. We'll learn more about that in a later chapter. B states the taxpayer generally is bound for tax purposes by the legal form that is selected. So this is important. This is one of those exam type questions. And as you were taking these professional exams, you always need to look at the words that are being used. So it says generally. It doesn't say the taxpayer is always bound for tax purposes. So in such case, you might say, hey, we have what's called check the box regulations. In such case, even though it's an LLC, it can be taxed as an S corporation or a C corporation, which is true. But this question is asking the taxpayer generally is bound. So in such case, that is why this is true. Unless they make those check the box elections to be taxed as a different form, it doesn't change their business form, it just changes their tax form. So this is true. C states a limited liability company, LLC, is a hybrid business form that combines the sole proprietorship characteristic of limited liability for the owners with the tax characteristics of a partnership. This is false. So in the event that the LLC combined a sole proprietorship characteristic of limited liability, I don't think anybody will want to set up an LLC. Why? Because as a sole proprietor, you have unlimited liability. So in the event that the business is sued and the business has no money, what can they do? Come after your personal assets. So this is incorrect. The correct verbiage would be that a limited liability company is a hybrid business form that combines the corporate characteristics of limited liability for the owners with the tax characteristics of a partnership. Here it asks, indicate whether the following statements are true or false regarding the non-tax factors in making business entity decisions. So for the most part, when most people decide on a business structure, yes, they are concerned about the tax implications, right? Those are things that they need to think about. And not just federal taxes, but also taxes at the state level, right? What is my tax liability going to be? Because as we'll come to learn, with certain tax structures, you'll save more money depending on the business form. However, taxes should not be the sole consideration for choosing a specific form of entity. right? Reason being, there are some non-tax factors, liability, right? The administrative burden that's associated with some of these organizational forms. These are all things that ultimately need to be considered. So it says, of the different forms of business entities, the corporate form offers the greatest ease and potential for obtaining owner financing because it can issue additional shares of stock. So this is true. And the reason why this is true, let's say, I have Robinhood and I decide to log into my Robinhood and I'm like, hey, you know what? Apple is doing really well. They're preparing to drop the iPhone 17 shares are, going to skyrocket. So in such case, I can just go right onto Robinhood and I can purchase shares. So with these corporations, they had the benefit of financing the business by issuing additional shares. They can also borrow money from individuals. So these corporations, they can also issue bonds as well. Versus if we have a sole proprietorship, for the most part, your business operates based on your savings and also based on, family and friends either investing in you or lending you money, right? So that's one of the greatest benefits of a C corporation. Next, we have B, the limited partnership form provides limited liability to all partners. So again, this is one of those exam type questions. It says all partners. That is incorrect. So with a limited partnership, there needs to be at least one general partner. So limited partners, they are limited to their investment and any additional investments or contributions that they make to the partnership. General partners, however, they are basically on the line for it all. Right? So imagine if Uncle Sam says, hey, in a limited partnership, it could just be, all limited partners. Absolutely not, because you know what? Individuals, they might, be more likely to be negligent, be more likely to be frivolous. So there's always that one person, the general partner, that is on the hook for everything. So B is incorrect. B is false. And the reason it is false is because the limited partnership form provides limited liability to limited partners, not all partners. And then C states a corporation offers its owners limited liability under state law. So this is true. Corporations are formed at the state level. And as you can imagine, we're going to learn a little later about what's called the entity perspective, the entity concept. And with the entity concept, a corporation is considered a separate entity. It is distinct with its own responsibilities and obligations. So with that being said, there's a bit more scrutiny. There's a bit more administrative burden and things that need to be considered when you become a C corporation, because again, the C corporation liability is separate from the liability of the owners. This question asks us to complete the following statements regarding single and double taxation. So it says blank are subject to single taxation. So one of the biggest downsides of the C corporation is that it's subjected to double taxation. So simply stated, let's say the corporation has $10,000 in net income. The corporation pays a flat 21% on that $10,000. And then from that $10,000, what's left over, the 10,000 minus the 2,100, right? They now have 7,900 left over. The after tax earnings, they decide, hey, you know what? We are going to distribute dividends to our shareholders. Now, let's say they distribute $3,000 of that 7,900 to their shareholders. Unfortunately, the shareholders, they are going to be required to report the dividends distributed on their behalf on their tax return, and then these shareholders also pay taxes on that dividend. So that is unfortunately one of the biggest downsides, disadvantages of the C corporation is the double taxation, tax at the corporate level, and then there's also tax at the shareholder level if a distribution is made. So this can't be our answer. It says only the partnership and LLC. So, okay, partnerships and LLCs, they are subjected to single taxation, though there's no tax at the entity level. But I don't know if that's the best answer. This would be our best answer because this also includes sole proprietorships. So the sole proprietorship, partnership, and LLC are subject to single taxation. Thus, the tax liability is levied at the owner entity rather than at the entity level. On the other hand, as mentioned, C corporations, they are subject to double taxation. And under double taxation, the entity is taxed on the earnings of the corporation, and then the owners are taxed on distributions to the extent that they are made from the corporate earnings. Next, it's asking us about state taxation. So it's asking us to complete the following statements regarding state taxation. So it asks, if the state law does not permit an S corporation election, then the corporate losses cannot be passed through to the shareholders to deduct on their individual tax returns. And in this case, owners should choose the limited partnership, publicly traded. So it would be the limited partnership option, right? So let's scale back and explain this a bit. So when there's a loss for a business, even though, losses on the surface seems like a bad thing, when you think about it from a tax perspective, losses can be a good thing. Let's say, for example, someone has, W-2 income, they're working a job, and their W-2 income is 50,000, and they have a business, and that business has a loss of $20,000. Depending on the form of the business, that determines whether or not the owner of that business can take advantage of the loss. So if it is a C corporation, remember, C corporations follow the entity perspective, which means that the C corporation loss only applies to that C corporation. It is distinct, separate from the shareholder, the owner. However, if there's a sole proprietorship or if there's an LLC, assuming they did not make an election to be taxed in a different way, the individual who has that $50,000 of income, let's say the loss was 20,000, they can offset their income by the $20,000 loss, effectively reducing their taxable income to $30,000. So that's one of the benefits again with the S corporation. However, in the event that state law does not permit the S corporation election, then the owner should choose a limited partnership. So again, these are one of the areas or an area where you can advise your clients if they anticipate having losses in the first few years of operating the business. You wouldn't advise them to set up a C corporation, right? Especially if they are a high income earner, because they can take advantage of the losses on their personal return versus if it is C corporation, those losses are held up in the corporation itself. All right. So now it's talking about minimizing double taxation. Again, yes, it is a challenge with the C corporation that there is double taxation, but there are also some really great benefits to a C corporation. So in the event that the entity forms a C corporation, therefore, what they will decide to do is to minimize taxation. So here it states to indicate whether the following statements are true or false regarding the tax techniques that are available for eliminating or at least reducing the second layer of taxation. So here it says transferring funds to shareholders that are not deductible to the corporation. This is false. This is not minimizing double taxation because, again, the chance here is that they want to eliminate or at least reduce the second layer of taxation. This is not a benefit. So transferring funds to the shareholder that are deductible. So here it says transferring funds to the shareholders that are not deductible to the corporation. So that would basically be issuing dividends. That does not minimize double taxation. However, if they transfer funds that are deductible to the corporation gets the benefit of writing it off, and then it benefits obviously the shareholder from a different perspective. Or, well, the shareholder would still pay taxes, on it, but the corporation would obviously avoid paying the double taxes. So in such case, some typical forms of transfer, let's say they're shareholder employees and they are working for the corporation, that can be written off. Let's say one of the shareholders owns a rental property or equipment that they now rent to the corporation. Those, shareholder, lessor, and lease payments can be written off. Or let's say there's interest payments to shareholder creditors. So these tax benefits, obviously, or these tax techniques rather, have benefits, but the IRS, they scrutinize these types of payments. Why? Because obviously there are individuals that try to take advantage of them, okay? And Uncle Sam don't play that. So they definitely scrutinize these things to make sure that they are actually deductible in nature. Why is the individual receiving salary payments? Are they actually working for the company? Why is the corporation paying money to the shareholder? Are they actually renting out their property, and are they renting it at comparable to fair market value? So again, this is a tax technique, but they are subject to IRS scrutiny. B states not making distributions to the shareholders. So this is true. So the only time in a C corporation that shareholders are subjected to that double taxation is when the corporation makes distributions. If the corporation doesn't make a distribution, then there's no tax liability to the shareholders. They don't need to report the Form 1099 DIV. However, right, one thing that Uncle Sam knows is that individuals, we could be kind of smart. So let's say there's a high income, earner. Let's say the individual works at a W-2 job. They make upwards of $500,000, $1 million, right? Life is pretty decent. They live within their means. They don't need any extra money, right? They don't need extra money in their bank account. So therefore, that individual that is smart, what they'll decide is, hey, you know what? I'm just going to leave the money in the corporation. And if I leave it in the corporation, then I don't need to pay any taxes on the dividends. However, Uncle Sam is smart. And we have what's called the accumulated earnings tax. So in the event that it's a closely held C corporation and they don't make distributions, Uncle Sam is eventually going to want to know, hey, well, you have all this money that's accumulated in a business. Why are you not distributing it? Unless there is a reasonable purpose, right? So let's say they're planning to expand in a few years and they are holding on to the money because they want to purchase a new building or something of that nature. There needs to be a reasonable purpose as to why the corporation is not distributing the funds. C states making distributions that qualify for return of capital treatment at the shareholder level. So this ties into redemptions and liquidations. So this is another way, another technique in which the entity can control tax. So this is essentially where, let's say an individual, they contributed $10,000 into the corporation and now they are receiving $10,000 from the corporation. That $10,000 can ultimately be treated as a redemption or results in a tax-free recovery of basis, the amount I initially contributed, and then the remainder can be treated as a capital gain. So this is true. And then D states making the S corporation election. So this is true. So this is one of the ways in which individuals can decide to minimize double taxation, because again, with the S corporation, it is a hybrid between the corporation and a partnership. This is asking us about the effect on results of operations. So it says indicate whether the following statements are true or false regarding the effect of results, or effect rather, on results of operations of the conduit and entity concepts. So as mentioned a little earlier, we have these two different concepts, these different perspectives. So with the conduit perspective, that simply means that they view the business as an extension of the individual. Entity perspective, on the other hand, that is where it treats the business as a totally separate entity. The business has its own rules and obligations, etc. So here it states the application of the entity concept results in the earnings component losing their identity when they're passed through to shareholders in the form of dividends. So this is true. So this produces specifically a negative result when we're dealing with capital gains. So capital gains, when we think about them from our perspective of how it impacts individuals, capital gains are taxed at a preferential rate. So we have 0%, we have 15%, and we have 20%. So when we are dealing with the corporation, and these taxes, or these capital gains rather, are passed through to shareholders, they do not retain that same status. It is basically just treated as a dividend. So in such case, unless it is a qualified dividend, then in such case, ordinary dividends, they are subjected to ordinary tax rate. So that is true with the entity concept. Again, entity concept, the business is treated as separate. B states the conduit concept allows any item that is subject to special treatment on the taxpayer's own tax return to be reported separately to the owner. So this is true. So with that conduit, again, this treats it as though the business is an extension of the individual. So let's think of it as an example whereby one shareholder they itemize on their tax return. So because they itemize, they get the opportunity to take advantage of charitable contributions versus shareholder B, the other shareholder who takes the standard deduction. They do not get the benefit of taking charitable contributions. So therefore, at the entity level, they would allocate the charitable contributions respectively to the individual shareholders, and then the shareholders would report it on their tax return, because again, it affects different shareholders differently. Same thing with capital gains. Shareholder A might be in a different bracket from B, so shareholder A might be subjected to 0% tax on capital gains, whereas shareholder B might be subjected to 20%. So different strokes for different folks. Lastly, we have C. The conduit concept is responsible for producing potential double taxation for the C corporation form. So this is actually false. So the entity concept, which is that the business is treated as separately from the owner, the entity concept is responsible for producing that potential double taxation. So again, under the entity concept, because the business is treated as totally separate, that is why the corporation pays taxes on the net income, and then they distributed dividends from the after tax income. And then unfortunately, the shareholders also pay tax on those distributions. So now in this question, we're just quickly going to compare the C and the S corporation. So it says blank or separate legal entities. So is it all corporations, only C, only S? So all corporations are considered separate legal entities. And it states for federal income tax purposes, blank or tax on its earnings. And if the corporate earnings are distributed to the shareholder, the earnings are. So this seems like a C corporation. So C corporations, they're taxed on their earnings at a flat 21%. And if corporate earnings are distributed, the earnings are subjected to a second layer of taxation for the shareholders. Next, we have a corporation that elects the S corporation. So if they complete Form 2553, then in such case, that entity that is making that election there can be elected to be treated as an S corporation. And remember, the S corporation is a hybrid, it's a combination of a corporation and a partnership. So a corporation that elects S corporation, they receive tax treatment similar to a partnership, with the corporate earnings being only taxed at, in such case, the shareholder level. So that's again one of the benefits of the C corporation. And another benefit of being an S corporation is that they also get what's called the QBI deduction. So with the QBI deduction, with the Tax Cuts and Jobs Act of 2017, effectively corporations were no longer subjected to a progressive income tax rate. So much like individuals, like Biggie Small said, more money, more problems, right? So with that being said, for corporations prior to the Tax Cuts and Jobs Act of 2017, the more money a corporation made, the more money they needed to pay. So with that being said, all corporations are now subjected to a flat 21% tax rate. So it doesn't matter if their net income is $1, if it is 100,000, a million, a billion, anywhere in between, it's an even playing field. Everyone pays 21%. However, the issue is that not all businesses are structured as a C corporation. So with that being said, the qualified business income deduction, QBI, that was also passed, and effectively that allows non-corporate business entities to deduct up to 20% of their taxable income as a deduction. So we'll put some numbers to it. Let's say there's an entity, an LLC, they have $10,000 of taxable income. Because of the change in the qualified business income deduction, if we multiply that by 20%, I mean, there are some nuances. Obviously, qualified business income deduction rules can be very complex, but just at the very surface level, $10,000, they get to deduct 20%, which is $2,000, ultimately reducing their taxable business income to $8,000. So that is available to non-corporate entities. It does not apply to C corporations because C corporations already have a flat 21% tax rate. So we move on to our next question. So here's asking us select either yes or no to indicate whether the following advantages are applicable to a limited liability company and or to an S corporation. So a limited liability company, I mean, it's in the name in and of itself. Does it have limited liability? Yes, it does. And the same applies to an S corporation. They both have limited liability. B states provides the greatest flexibility in terms of the number of owners. So, you set up a multi-member LLC, you can have a plethora of members. S corporation, however, this is not true. With an S corporation, there are some limitations. So the shareholders are limited to 100. And another caveat is that they need to be U.S. citizens. So S corporations do not provide a great flexibility in terms of the number of owners. C states taxed as or similar to a partnership. This is yes. Both are considered pass through. And then lastly, we have D. Losses can be passed through and deducted by owners. This is true for LLCs. And this is also true for S corporations. But one thing to point out with S corporations, we have this new form, came out several years ago, Form 7203. So in such case, for an S corporation, yes, you can deduct the loss so long as you have a basis in the corporation. So let's say a corporation has a loss of $10,000 and the shareholders' basis in the S corporation is only 5,000. They can only deduct the loss up to the basis, which in this case will be 5,000. So I believe that this is one of Uncle Sam's ways of cutting down on individuals taking advantage of losses. So that applies to the S corporation. Form 7203 tracks the basis in an S corporation. So here we have another similar question, and it's asking us to identify the effect. What is there an increase, a decrease, or no effect of each of the following on a partner's basis for a partnership interest and a shareholder's C corporation and S corporation basis for stock? So this is again very important. Why? Because there are going to be certain instances where you are advising a client and they have these questions. They want to know, hey, what's the impact of profits, losses on the basis, right? Not just on a basis, but for tax purposes. So all of these different things make a difference. So it's important to know how they are impacted. So when there are profits for a partnership, for a C corporation as an S corporation, is it going to impact the basis? So for a partnership, it is going to increase the basis. For a C corporation, again, following the entity concept, the entity perspective, the C corporation is separate. So therefore, the profits of the C corporation will have no effect. For a shareholder in an S corporation, it will increase their basis if there are profits. Losses, on the other hand, obviously are going to decrease the basis for a partner, has no effect for a C corporation, and it also decreases the basis in an S corporation. When there's a liability increase. So one key thing about liabilities, they have an impact. It enables the owner to benefit from what's called the leverage concept. So in such case, with a partnership, the liability increase is going to increase their basis. However, as it relates to a C corporation, it has no effect. And the same thing for an S corporation, there is no effect. Decreases for a partnership obviously are going to decrease their basis. And the same thing applies for the C and the S corporation. Liabilities have no effect. So again, important things to know. So that way, as you are guiding the client to help them determine which structure is best, you need to factor in these things. Hey, is the corporation going to take out any loans? Is the partnership going to take out any loans? Or is the business rather going to take out any loans? So that way you can advise them, hey, well, if you choose the partnership route, liability increases, impact the basis as well as decreases. Versus if it's a C or S corporation, liability has no impact on the basis. So something to consider. Next, we have contribution of assets. So across the board, if it's a partnership, if it's a C corporation, if it's an S corporation, any contribution of assets, it increases the basis. And next, we have the distribution of assets, non-liquidating. Let's assume that it's classified as a dividend. In such case, a distribution for a partnership is going to decrease it. For a C corporation, it's going to have no effect, right? It's basically them sharing in their earnings to the shareholders. That has no effect on the basis. And for an S corporation, much like a partnership, distributions also decrease the basis. So now we have this question. This is a very good question for us to see using numbers, how all of these things come together. So we have mirror, we have lemma, and it says mirror and lemma are equal partners of an entity. Each contributed 51,000 cash to the entity. In addition, the entity obtains a loan of 204,000. The profits for the year are 61,200. Determine mirror and lemma's basis of ownership interest at the end of the period, assuming the entity is a partnership, a C corporation, or an S corporation. All right, so put this together, this Excel, to kind of make it just a little easier. All right, and we're going to use these to work it out together. So we have these three, structures. So C corporation, partnership, S corporation. So in such case, I'm going to make this a little bigger. So let's say we start off with a partnership. So the beginning basis for both of them, Mira and Lima, is 0, right? They're just starting out this entity. So it says that they're equal owners of the entity. So with that being said, I'm going to make this a little, all right, perfect. All right. So with that being said, here it says they both contributed 51,000 cash. So they both contributed 51,000, 51,000. Now, in a partnership, as we just learned in the previous example, they obtained a loan and the loan increase is going to impact their basis. So 100% of the loan is 204,000 and Mira is 50% owner, so therefore her basis is increased by 50%. And the same thing applies to Lemma. So both of their basis is going to be increased by 104,000. And then it says that profits for the year was 61,200. And that represents 100%. But again, they're 50% owners, so they split it evenly. So therefore, Mira's ending basis is going to be the beginning basis plus the contribution plus her share of liability plus her share of profit. So therefore, the ending basis for both Mira and Lemma, if they're a partnership, is 183,600. So now we move on to if they were a C corporation. So as a C corporation, again, they both start off with the beginning basis of 0. And in such case, remember, now you're dealing with a C corporation. It doesn't matter what their ownership percentage is. The only thing that has an impact, the loan has no impact, the profit has no impact. Maybe the corporation will be nice enough to give them dividends, but in such case, the only thing that impacts the basis for Mira and Lemma based on this fact pattern is their contribution of 51,000. So therefore, their ending basis, if they were a C corporation, is 51,000. So now we see if it were an S corporation. So in the event, I'm just going to give us some more space. All right, so in the event that it were a S corporation, right? How are things going to be treated in such a case? So here we see with this S corporation, the beginning basis, again, is a brand new entity, so 0. They both contributed 51,000. But again, for an S corporation, the loan has no impact. So it makes no difference to us, the loan amount. However, the profit does make a difference. The 61,200 is going to be allocated evenly to both Mira and Lemma. So Mira gets 50% of that 61,200. Lemma gets 50% of that 61,200. So if we add it up, then we see for Mira, the ending basis is 81,600, and the same thing for Lemma. All right, so obviously we see that based on the structure of the business, if it is a partnership, a corporation, a C corporation, or an S corporation, all of those things ultimately have an impact on the ending basis. So this is a great example of ultimately showing you the impact that the type of business structure, the impact that it has on the basis. And then in this next problem, we're going to see the implication of the tax basis. My apologies, let me make this a little smaller. All right, so we're going to see the implication of the form of business from a tax perspective. All right, so here for this question, it says Plum evaluate, rather, sorry, I'm starting from the last sentence. It says evaluate whether Plum should operate as a C corporation or as an S corporation given the following assumptions. So Plum Corporation will begin operations on January 1st. Earnings for the next 5 years are projected to be relatively stable at $76,000 per year. C corporations are taxed at 21%. The shareholders of Plum are in a 32% income tax bracket, and dividends are taxable at 15%. Assume, if applicable, the qualified business deduction is available and not subject to any limitation or phase out. Evaluate whether Plum should operate as a C corporation or as an S corporation given the following assumptions. So for part A, it says Plum is going to reinvest its after-tax earnings in the growth of the company for the foreseeable future. So simply stated, they're not going to give any of their, earnings to the shareholders. And some corporations do that. So in such case, if Plum operates as a C corporation, so we're starting off with part A, we know that the taxable income of $76,000, and corporations, as we mentioned, they are subjected to a flat 21%. So with that being said, the tax liability, fairly easy to figure out. 76,000 multiplied by the tax rate, which is 21%. So therefore, the tax liability is going to be 15,960. Straightforward. And in this case, the corporation's taxable income, 76,000, less their tax liability of 15,960. So their after-tax earnings is 15,960. But remember, it says that they are not distributing any of it. So therefore, the shareholders have zero tax liability because the corporation has decided that they are not going to distribute anything. They are going to invest in growth. So therefore, the shareholders' tax liability is going to be zero. So in the event that here it says, if Plum operates as an S corporation. So in the event that the entity operates as an S corporation, again, for part A, the S corporation pays taxes at the shareholder level, not the entity level. So therefore, they're not going to pay anything here. And then now, what we ultimately need to figure out for the S corporation is as follows. So for the shareholder, now actually make some more space. All right. So for the shareholder, their liability will be as follows. So shareholder. So here's how it works. So we ultimately have taxable income. And from there, we have less the QBI deduction, which is 20%. So this will be 20%. So the taxable income of 76,000, the QBI deduction, again, which we know is 20%. So that ultimately represents the amount that is not going to be subjected to taxes. So therefore, 76,000 multiplied by 20%. So therefore, so let me change this verbiage around. So business income is 76,000. And then again, because of the change, the flat 21% for corporations, they now get the benefit of writing off 20%. So therefore, so QBID percent and then less qualified business income. So therefore, 76,000 minus the 15,200, that leaves them with 60,800. And then it lets us know that their tax rate times the tax rate. In the problem, it lets us know that their tax rate is 32%. And I'm going to change this to a percentage. All right. So therefore, the tax liability for the shareholder is going to be the taxable income after the QBID deduction, 32%. Let's make this a number. So therefore, the shareholder's liability will be 19,456. So I'll run that from the top. So for the shareholder, and again, this part of the problem is asking if instead of a corporation, they were an S corporation. So the business income in this case is 76,000, as we see here. But we know that if they are subjected to the qualified business income deduction, because of that, they ultimately get to take a 20% deduction. So therefore, we take advantage of the 20% deduction. And when we multiply it, that gives us 15,200. So the taxable income is 60,800. And it says that they're in the 32% tax bracket. So therefore, in this scenario, their tax liability will be 456. So if we look at it and we compare the two, and I'll get my handy dandy calculator. So as a C corporation, they would pay $15,960 versus the S corporation where they would pay $19,456. The difference is, as a C corporation, they would save $3,496. So therefore, it would make sense in this situation for them to be a C corporation. But again, they're not distributing any of the earnings. So now we move on to part B. So now in part B, this is essentially telling us, now copy this down. So now for part B, this is telling us that, if they operate as a C corporation and they're going to distribute their after-tax earnings each year. So the taxable income didn't change, it's 76,000. The tax rate is still 21%. So the tax liability is pretty much going to be the same, 76,000 multiplied by the 21%. Which is 15,960. Doesn't change. But now the issue is that they are distributing after-tax earnings. So the corporation's taxable income was 76,000. The tax liability, as we just calculated, was 15,960. Well, I'm missing the 5. 15,960. So the after-tax earnings in this case is 60,400. And in the problem, it lets us know that the dividends are taxable at 15%. So therefore, our shareholders are going to pay 50% on this 60,040. So therefore, the shareholders' tax liability is going to be 9,006. And now, if they operate as an S corporation, we already did the math. So similar to the previous problem, it's going to be 0 at the S corporation level, but they're going to pay 19,456. So same calculation as what we did before. But now we see that there's a difference. So because the C corporation is going to be distributing the earnings, this is the issue with the double taxation, because now we see before the corporation, when they didn't make a distribution, they were only paying 15,960. The shareholders paid nothing because there was no distribution. In part B, they are making a distribution. So the corporation pays 15,960 and the shareholders pay 9,006. So in total, between the corporation and the shareholders, they're paying 24,966, compared to if they were an S corporation, they would pay 19,456. So that's a difference of $5,510. So therefore, from an entity owner perspective, it would make sense for them to be an S corporation. So again, this is a great example showing you the difference between how you can assist clients with making the decision to choose a specific business entity. So as we see in one situation with the C corporation, when they're not making distributions, yeah, it makes the most sense for them to be a corporation. But when they are distributing earnings to shareholders in such case, then it becomes more costly and it's better for them to be an S corporation. All right. So, again, this is a great area of taxation as a tax professional for you to really understand. So that way, ultimately, when clients come to you with questions, they want to start a business or they want to figure out ways in which they can save taxes, or, obviously not just saving in taxes, but also the non tax factors. This is an area where you can provide your expertise and make a difference. So, this brings us to the end of questions for Chapter 12, Comparative Forms of Doing Business.